The housing market is crashing. Crisis mode, housing crash imminent. These are probably the titles and thumbnails of some of the videos that you've seen recently on the housing market. In this video, we're going to dive deep into the data to see exactly what's happening in the housing market right now in 2022. Hey guys, I'm Preston from Finance Mind, where I help you invest, make better financial decisions, and talk all things business. The housing market over the past year has seen literally unprecedented growth. We have never seen anything like this before, not even in 2008. In this video, I want to cover three primary topics. Number one, how did we get here? What are the key drivers that have led to this skyrocketing market? Number two, why are some of these experts and YouTubers predicting a crash? And are they right? And three, where is the market actually going to go over the next year? I'm going to take you over to my handy whiteboard so we can walk through all of these questions. All right, everyone, just to make sure that we're all on the same page, I wanted to share this data from Fred on the US housing market index and what's been happening since 2020. As you can see, we're seeing massive increases of 20% plus just over the course of 2 years. All right, guys, as we just learned from the Fred data, this is the same chart I've replicated here. From 2020 to 2022, we're up about 20% here on this chart. So the question that we're trying to ask here and answer is, where do we go from here? Does this line continue to go up? Does it flatten out? Or does it start dropping and crash and burn territory? To answer this question, I think the best way to do it is to look at what has been driving the growth. First of all, these drivers will help us understand how we got where we are, and then we can compare what the situation is today and how that might impact the housing market going forward. All right, so let's walk through some of the key drivers on the demand side of what has driven such demand in the housing market. So first, we have remote work. Of course, in 2020, everybody shifted to remote work, which meant people could really work from anywhere. Homes became more important. People might have wanted to upgrade to some bigger space so they had an office, or wanted to work somewhere nicer, Hawaii or Florida, wherever it might be, that had nicer weather year round. And this ties nicely into my second point on migration. People were shifting away from high cost of living areas into lower cost of living areas where they could afford bigger homes and have more space for them since they were spending so much time at home. Next would be the second home buyers, right? People who now realize that they wanted to spend more time somewhere else, didn't necessarily have to sell their first home, and could go and buy a second home. Fourth reason here are the iBuyers. So these are all those companies like Zillow used to be, Open Door, these companies that might have sent to you letters in the mail who are asking to buy your home without even stepping foot into it or seeing it. These companies are known as iBuyers, and they became extremely prolific starting in 2020 all the way through 2022 of purchasing real estate. And in many cases, these iBuyers were paying significantly over market values, contributing to market prices skyrocketing. The fifth point I have up here is the stimulus payments that we all received from the government. So these weren't massive payments, obviously not enough to buy a new home with, but definitely contributed to people having a bit more spending money, maybe a bit more savings in their account so that they could afford their first down payment if they're a first-time home buyer, or even for investors. And then finally, and probably most importantly, the absolutely rock bottom low interest rates. These low interest rates contributed significantly to people having more purchasing power, more buying power than they did before, so they could afford bigger and bigger homes with the same amount of payment. So what's the net effect of all these drivers on the demand side? I think it's pretty clear. It's a positive upwards effect on demand. So all of these are contributing to more people wanting houses, more people being able to afford houses, and companies coming in being willing to pay a lot more for houses. All right, now that I've listed out some of the drivers on the supply side, so what's contributing to either increasing the supply or decreasing the supply of homes? So number one, we think back to 2020, building slowed. A lot of builders just absolutely stopped working on projects or weren't able to work on projects for a number of months if they were quarantined or not able to work outside or with other people. Next would be the material shortage. As we all know, supply chains are not in a good place right now. There's just a lot of demand for goods and people aren't able to get the products and services that they need. Third would be our labor shortage. Again, as you all have seen, for unskilled labor, as well as for skilled labor, we're seeing massive shortages and people are having to pay a lot more to get the same type of labor that they were getting 2 or 3 years ago. Fourth would be the Foreclosure Moratorium. So the government stepped in and prevented people from being foreclosed on by banks, even if they weren't meeting their payments. So somebody could be living in a home, not paying anything, and yet they were not able to be kicked out. And then finally, hesitancy. I think there are a lot of people and families that were hesitant to place their homes for sale because as the prices of homes in the market became more and more competitive, people would step back and say they don't want to jump into this, they don't want to have to get into bidding wars with people, and they don't want to have to pay $100K, $120K over asking price. Okay, so now that we've walked through these drivers on the supply side, what is the net effect? What are these drivers doing to supply? And I think as you can see here, all of them are contributing to decreased supply. So now that we know what contributed to the massive increase in 20% over the course of 2 years in home prices across America, now let's talk about why people are even predicting a crash is going to happen this year. What is causing them to think that there's going to be a massive shift in the market so that prices are going to fall back down to where they were 2 years ago? Honestly, I think this is a pretty simple question to answer. From what I've seen, a lot of people are just saying because prices have gone up so fast and so high, similar to what we saw in 2008 where we saw a run up in prices, that it's just not sustainable. It's not affordable for a lot of people. Because of that, prices just have to come down. There's no other logical option or outcome for what's going to happen. Now, here's where I disagree with most of these people. I think that the market today is fundamentally different from what it was like in 2008. And they're missing the mark on what caused the recession in 2008 versus what may or may not cause a recession or a subsequent housing crash today. In 2008, it was the loose lending practices of banks that led to people not being able to afford the homes that they were getting into. I mean, people with extremely low incomes were getting into $1 million, $2 million homes, and as soon as they hit a little bit of a rough patch, these people could no longer afford their homes and they were getting foreclosed upon. Essentially, the housing market was a house of cards. As soon as the economy felt a little bit of rumble, a little bit of a tremor, then all of the pieces started to fall apart and the house of cards started to collapse. An important stat from 2008 is that people were spending about 7.8% of their disposable income on their mortgage payments, whereas today that number is just 3.8%. So we're in a fundamentally different place than where we were before. Due to all the laws and regulations put in place after 2008, banks have been much more strict and stringent on lending practices, and so we aren't in a position where people can't afford the homes that they're in. And even if the people couldn't afford the homes that they're in, most people are sitting on massive amounts of equity and they could easily sell their homes without going into foreclosure and not be underwater in their payment or in their loan. So that was the key driver in 2008. It was not the high home prices or the massive increase that they saw in the run-up before in 2006 and 2007 in home prices. It was actually the inability of many of the people getting loans to pay their mortgages, which is fundamentally different from where we are today. Now let's cover the third topic for today. What is the housing market doing today? And the big question, what is it going to look like a year from now? To do that, I want to revisit the drivers of growth that we saw contributed to the growth of the housing market over the last 2 years. And now let's see how those have changed and how that might impact the housing market moving forward. So we're going to take a look at each of these drivers and see what's changed from then until today. Starting with remote work, I don't really see much of a change. There's not an increased amount of people working from home today versus in 2020. In fact, it might be slightly declining. So I'm going to leave this as flat. Migration, I think similarly, I'm not seeing any massive increases in migration versus 2020. Second homes, again, probably flat. Now, iBuyers. As you all know, Zillow pulled out of this market and are no longer buying homes at all. We still have Opendoor and a few other companies. So I'd say net, this is probably slightly down. Stimulus payments, unfortunately, are over. I did enjoy the extra money in my pocket, but as we saw, that contributed massively to inflation. So now that this is over, I would say that this is declining as well. And finally, probably the most important one is the low interest rates, unfortunately, are over. We've seen interest rates skyrocket from about 3% in January to over 5% today. So to help put that in perspective, what a 2% increase in rates looks like, if you have a loan on a $500,000 home, that would mean you're paying about $600 more a month for that same exact home at that same exact price than you would have back in January. So it's really contributed significantly to affordability and has pulled a lot of people out of the market because they just can't afford the payments. So this again would be decreasing. So then summarizing what we see as far as the demand drivers, I see flat to some declines here. So I don't see the demand skyrocketing again that would make me think that the housing market's going to continue increasing. The key question here that is the toughest one to answer is how much is this low interest rate really going to bring down the market? And I think this is where some people would argue low interest rates are absolutely going to kill the market. I think it's still a little bit early to see. We'll see how far the Fed raises rates. And if we end up at 7, 8, 10, 15% interest rates, then I think my answer would probably change. But I think for now, I see this as cooling the market, but I don't see this as wiping out the floor and us just coming into free fall. Okay, so now shifting over to the supply side. So building slowed in 2020. This has definitely increased. So now we're having more homes come onto the market more frequently. Material shortage, this is still definitely a challenge, I think better than 2020. So I'll keep this as flat. Labor shortage, I think similar to materials, we've started to figure things out, probably flat. Foreclosures, now this is something that, again, I've heard a lot of people talking about. Now that the moratorium has ended, we're starting to see a few more foreclosures, but nothing absolutely massive where we're seeing hundreds of thousands or millions of homes hitting the market because people can't afford them. So I'll say this is slightly increasing the supply. And then I think finally, hesitancy on people that were afraid to move before. I think we're starting to see that ease up. So we are seeing more people now listing their homes and being willing to move. And I think as we get into the summer, which is peak moving season, we'll start to see a lot more homes hit the market. So now we have to look at the net effect of the demand drivers to the net effect of the supply drivers to see how the balance has shifted, and is this going to cause the housing market to absolutely crash? I think, in my opinion, this is absolutely going to cool the market. I don't think we're going to see another year of 10, 15, 20% growth, but I also don't think the market has cooled off so much that we're going to see prices plummet. So I think because of these things, I could see us being flat to maybe slightly down as interest rates continue to rise. Maybe we could see nationwide a 3 to 5% decrease, probably 10% decrease at worst. So I'd love to hear your opinions as well on this. Comment down below if you think I'm missing any of these drivers on the supply or demand side, and whether you think I got the directions right and the magnitude. Love to hear your thoughts as well. All right, guys, thank you so much for watching. If you enjoyed the video, please smash that like button and subscribe to the channel for more. And I hope to see you in the next video.